International Trade and Industry Deputy Minister Dr. Ong Kian Ming has defended Putrajaya's move to buy out 4 toll concessionaires, saying motorists would otherwise have to pay up to 67% more to use tolled highways. According to Ong, the Damansara toll, for instance, would have seen a 25% hike to RM2.50, while Penchala Link users would have to pay RM5, a jump of 67% from the current RM3 toll. He added that acquiring these tolls would remove the temptation to extend the concessionaire agreements in order to defer compensation to the companies. Last Friday, the government said it was offering to take over 4 toll highways owned by Gamuda and Litruck Holdings in a deal that values the concessionaires at the enterprise value of RM6.2 billion. The highways involved are LDP, Sprint, Kesas and Smart. The acquisitions are said to have no cost implications to the government, since they will be funded by the proceeds on the toll collections. Sunway Construction Group has bagged 3 projects with a total of RM496.8 million. That's pushed the total projects it secured year to date to RM1.54 billion, exceeding its target of RM1.5 billion for 2019. The builder said in a filing to Bursa Malaysia today that it secured a RM310 million job to build the Petronas Leadership Centre in Bangi. The second project award is from Sunway South Quay for earthworks and piling in Sunway City, Kuala Lumpur. This contract is worth RM119 million. The third job is from Oxley Rising to supply and commission an electrical system for a proposed mixed commercial project in Jalan Ampang for RM67.8 million. Suncon Group MD Chung Soo Kyong says the group is pleased to have met its 2019 target well ahead of the end of the year and will continue to work to secure new contracts and move forward with its expansion strategy into ASEAN and India. Putrajaya Group is confident of securing a portion of the contracts meant for local contractors for the ECRL project. Group MD Datuk Ang Cheng Siong says Putrajaya has a proven track record in specialised areas, namely bore piling, foundation work, bridge construction as well as flood mitigation works. Ang adds that the company has already submitted its application for the pre-qualification exercise for the ECRL project and is currently awaiting the results. Aside from that, Putrajaya is also looking to bid for up to RM2 billion worth of infrastructure and building construction jobs for the public sector. Currently, the group's order book stands at RM875 million, which will provide earnings visibility for the next 2 to 3 years. These jobs are mostly for infrastructure projects, including LRT3 and the Setiawangsa Pantai Expressway Duke Phase 3. As such, Ang is hoping that Putrajaya will return to the black in the third quarter of FY19, after posting losses in the first quarter. Tasik Corp's minority shareholders have been advised to accept Hong Leong Asia's takeover offer. The Singapore-listed firm wants to take Tasik private in a deal worth some RM128.61 million, based on the offer price of RM5.50 for both ordinary and preference shares. Independent advisor Mercury Securities says the offer for the ordinary shares is reasonable and fair. It highlights that the offer is higher than and represents a premium of 3.19% to 7.63% over the range of estimated value per ordinary share of RM5.11 to RM5.33. However, it believes the offer for the preference shares is not fair, considering the offer price is lower than and represents a discount of 9.98% to 13.11% over the range of estimated value per preference share of RM6.11 to RM6.33. Still, Mercury points out that the shares have been illiquid and the offer provides an exit opportunity to shareholders to realise their investment at the offer price. Therefore, it says the offer is still reasonable. Tasik ended the day unchanged at RM5.52. Loss-making Utusan Melayu Malaysia is selling off an apartment unit it owns in Indonesia for RM1.45 million to unlock the immediate value of the property. In a filing to the stock exchange today, Utusan said the property measures 254 square meters and is located at the Beleza Permata Hijau in Jakarta. The disposal, which the group said was in its best interest, is expected to result in a net gain of about 179,928 ringgit to be used for working capital as well as to partially fund payment for its voluntary separation scheme. Utusan wrapped up its FY18 with a net loss of 186.6 million ringgit, compared with a net loss of 7.46 million in FY17. This marks Utusan's largest annual loss in its 7 consecutive years of bleeding since FY12. However, the group has said it is very positive it will be able to bounce back from its financial crisis after seeing changes in its shareholding structure and having successfully implemented the VSS scheme.